Everyone, this is for class 12 and the chapter financing, or finance, the chapter finance, and under the finance I'm going to discuss a topic called capital structure. Capital means money required by the business for its business operation and growth. This money is also termed as fund required by the business. And for a company, for a joint stock company, the fund can be basically divided into two parts. One is borrowed capital or fund, or it is owned capital or fund. Borrowed capital is also known as loaned capital. It is a loan taken. So borrowed capital will include the sources of capitals like loan, debentures, public deposits, and so on. Whereas your owned capital includes shares. It can be equity shares and also the preference shares. And your retained earning. Right? So when we talk about the owned capital, normally equity shares comes under owned capital, equity share and retained earning will come under owned capital, and whereas the preference share capital are normally or generally termed as hybrid source of fund. Now for a joint stock company, there are two sources of capital. There are so many sources of capital. These sources can be loan, debentures, public deposits, shares or retained earning. How does a company get the money for its operation is known as capital structure. So when we talk about the capital structure, it means it is a mix of different sources of capital. That is known as capital structure. Mix of different sources of capital. A capital of a company can be loan capital, which is also known as debt fund, plus own fund. Debt fund plus own fund. The use of loan plus debentures plus shares plus reserve and surplus or retained earning all together will be considered as capital structure. So capital structure will basically tell you how much of loan, what amount of debenture, what amount of shares and what amount of reserve and surplus have been used in the total capital of the company. That's what is known as capital structure. Use of debt with shares. Use of debt with shares is known as financial leverage. Use of debt with shares is known as financial leverage, and it is also known as trading on equity. It is also known as trading on equity because this debt is used in the capital structure of a company on the basis of the shares. That is why it is called trading on equity. And trading on equity is done with some objective. And what is that objective? Maximizing the wealth of the shareholders. If debt is more than the share capital of a company, then it is called high leverage. The capital structure is highly leveraged. If the debt amount is less than the share capital, then it is termed as low leveraged capital structure. Okay? The leverage can be favorable, or it can be unfavorable. Now, when it is favorable, when it is good for the equity shareholders, when return on investment is greater than your cost of debt. When the rate of return is greater than cost of debt, it is good for the shareholders because this will increase the earning per share. This will maximize the wealth of the shareholders. Now, if ROI, return on investment, is less than the cost of debt, if the return on investment is less than cost of debt, then this is unfavorable, this is not desirable because this does not maximize the wealth of the shareholders, equity shareholders. Now, what is ROI? Return on investment. What does it mean? So, what is the return earned by a company on the investment made, on the total investment made by the company? So, your ROI is profit before interest and tax. Profit before interest and tax divided by total investment. And what is your total investment? This is your total investment, right? So this is your ROI. ROI means profit before interest and tax divided by total investment. This is the formula to find out the return on investment, which we learned in accounts. And total investment means debt fund plus own fund will give you the total investment. So if this ROI is greater than the cost of debt. Now, what is called cost of debt? Cost of debt means interest paid on debt fund. Interest paid on debt, that is the cost of debt. So if the return, if the profit before interest and tax divided by total investment, which is ROI. If ROI is greater than cost of debt, it is favorable. It is favorable because it will increase your wealth. It will increase the wealth of the shareholders. Whereas if ROI is less than cost of debt, then that will not be favorable one because that will not maximize the wealth of the equity shareholders. What amount of debt should be used in the company, in the capital structure of a company, depends on number of factors, right? But the reason for using the debt fund in the company, in the capital structure of a company, is to maximize the wealth of the shareholders. Who are the owner of the company? It is the shareholders. Which shareholders? The equity shareholders. And the objective of every business organization is to maximize wealth. Maximize wealth of the shareholders. And this wealth of the shareholders can be maximized in two different ways. Dividend, by paying dividend, and by having capital appreciation. By having capital appreciation. If the company keeps on paying dividend, the shareholders will be happy because their wealth will be maximized. And the other way of maximizing the wealth is appreciating the capital, that is increasing the value of capital. This capital appreciation has a relation with the market price or the market value. So it depends on the market price, that is the price at which the shares are traded in the stock exchanges. If the market value increases, the increase in the market price of a share leads to capital appreciation. And this market price has a direct link with the earning per share. If the company's earning per share increases, then the market price will also increase. So in order to maximize the wealth of a company, in order to maximize the wealth of the shareholders, earning per share should be increased so that the market price will increase. This increase in market price is the capital appreciation. Capital appreciation leads to the maximization of wealth. Okay. Now, what is earning per share? Earning per share is profit after tax and dividend divided by number of equity shares. Or in other words, it is also known as profit available to equity shareholders divided by number of equity shares will give you earning per share. This is how we calculate. So earning per share also has a relation with the profit after tax and dividend, or the profit earned by the company. Debts are used in the capital structure of a company in order to give more return to the equity shareholders. Now this use of debt with share capital is also known as capital gearing. It is also called capital gearing, right? So at the end we can sum up. What is the capital structure? So capital structure is what? It is a combination. It is a combination of different sources of capital of a company It is a combination of different sources of capital of a company. So that's what a capital structure. So it shows how much of loan, how much of debenture, how much of public debts, right? That is fixed interest bearing instruments. These are called fixed interest bearing instruments are used along with share capital in the total capital of a company. It shows how much of loan, debenture, public deposits are used along with shares in the total capital of the company. So this is what a capital structure is.